You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
So what I want to do today is I want to do deal analysis. I'm going to show you how I analyze storage facilities. I hope this helps you. I'm going to take you through my deal analysis process, the underwriting process. I'm in the process of buying a facility for $2.4 million. Now, I get that a lot of you cannot afford a $2.4 million facility. All right. I know you guys are all here because you want to buy your first facility. So please don't worry about the price. All right. Don't worry about how much I'm spending on a facility. All right. Because it doesn't matter if it's $2.4 million or it's $600,000 or $250,000. Your underwriting is pretty much the same until you get into these massive, huge, facilities that are like 50,000 square feet big or bigger or whatever, and even then, most of your due diligence is almost the same. But, so don't worry about the price. The first 11 facilities that we bought were under $1 million. And the process that I'm showing you tonight is the exact same process that I bought for them. Now I'm buying properties that are between $1 million and $3 million, right? So that's why I'm showing you, because this is what I'm buying. All right. This is what I'm buying. So don't worry about the price. All right. I want you guys to know that I'm here to help you get your first facility under contract or your next facility. You guys can tell me how many facilities you have if you have more. But I'm here to show you how I do the underwriting, how I look at deals, how I analyze deals. Doesn't matter what the price is. Okay. All right. So, and then also another thing too, I just want to point out that this webinar is every Monday night. I teach every Monday night. It is not the same webinar every Monday night. This is the series is how do I get a facility under contract within the next 90 days? How can I own a facility in the next 90 days, or next 90 to 120 days? All right. So that means that this content every Monday is completely new, completely different, and it's not an overall big picture of how to invest in self-storage, because who wants to listen to that? You can listen to podcasts on that. You can go onto YouTube. Everybody is teaching you how to get started in self-storage investing. And then they give you all the major bullets of what you can do, but they actually really don't teach. Okay. So I teach every Monday night, completely different information. And I'm telling you that if you show up every Monday night over the course of the next couple of months, you will have a very good idea of actually what to do, right? This is I'm actually teaching you. I'm not giving you an overview. If you want an overview, all you have to do is go onto my YouTube channel, and there's Self-Storage 101 videos all over the place. All right. Listen to my podcast. All right. Listen to, that kind of stuff. But this Monday night is me actually teaching you, getting to the nitty gritty and teaching. All right. That's really what it is. And let me see what else. Yeah. And then if you really want to speed things up, I highly recommend that you buy my course. Yes, it costs a little bit of money to buy the course, but you will get over 100 videos in one place, taking you step by step by step by step. And then while you're doing that course, come here and you listen to me teaching you. And then on top of that, you join my Facebook group. And that is where you'll be able to communicate and ask questions as you go through all of this and really, take action and implement what you're learning. You can come into the Facebook group and then you post out your questions, right? And then I'm here and my team is there to answer your questions and to guide you along the way. So overall, those three things, right, can really help catapult you. Now, what I'm going to show you tonight is our deal analyzer. This is a brand new deal analyzer that we just implemented this past year, right? And my virtual assistants started using it, and they were my guinea pigs, because if you guys remember, I have like 12 virtual assistants that work for me, and they do nothing but, find storage facilities for my students. And so I had them kind of, play around with the deal analyzer. And it took a good 3 or 4 months, honestly, to really fine tune that. And then I handed it over to my students, and then my students used it for about 3 or 4 months. And then they got really good at it. We made sure everything was perfect with it. And now I'm releasing it to the public, right? And so the public is allowed to buy this deal analyzer if you want to. And within the deal analyzer, if you buy the deal analyzer, there's a bunch of videos and stuff going over, taking you step by step on how to use it. But I'm just going to show you today the facility that we're buying, and we're closing in about a month, I would say, maybe less than a month. And it's an all climate control facility, and it's near Orlando. And so I'm going to show you the numbers on it. And I'm going to kind of go through it and just give you an idea. And I'm going to show you how we're going to pay for it as well, too. So I think if you guys can hang on to this, if you can hang on throughout this session, then you'll get a good idea of how it is. Okay, so let's do deal analysis. Let's do self-storage. Let's do self-storage deal analysis. So when you talk to an owner, so this is we are skipping stage one, we're skipping the first couple of steps of how to find facilities. This is you've already talked to owners, or you've looked on Crexy or whatever it is to get the information. You want to make sure when you do deal analysis, you are getting these things from them. This is what you have to get from either the realtor, if you're working with a realtor, broker, or from the owner. All right. Number one is you've got to get, if they will give it to you, the purchase price. Purchase price. Okay. Now, most of the time, they're not going to give you this, right? They're going to be like, oh, just make me an offer. But my virtual assistants and I, we really push to get this. Okay. So the script that we use in order to get the purchase price, and actually my virtual assistants are getting really, really good at this. The script that they use is, look, I can give you an offer, right? And I would love to just give you an offer. But the truth is that if you actually give me the number that you're thinking, then, we can run our numbers based on that and see if we can get, close to it. All right. And then also another thing is, if you've been offered something and you've rejected that, please let us know that as well. Because, I do not want to piss you off by offering something, cheaper, slower or whatever, right? So if you've been offered something, then please let us know what that is also, so that we can make sure that if you want something higher than that, we're above that. All right. So that's basically that's the script that we use is look, we want to give you a fair offer. Can you give us the price that you're thinking so we can run our numbers on that? Otherwise, we're going to be just shooting from the hip and just giving you an offer. All right. So that's good. And I'm telling you, if you ask them, I would say it's 50-50. If you ask them, 50% of the owners are going to give you the price. Now, obviously, if you work for a realtor, they're going to give you the price, right? And so you already have that. But if you're talking directly to the owner, you really kind of need to get it out of them. So you have to kind of base it, you got to say it like that. Okay. So purchase price. Okay. And let me see here. I'm going to kind of just erase this a little bit. It's annoying me to see. Okay. It's not pretty enough. Number two is you want the vacancy percentage. And there's two types of vacancy percentages. There's the economic and there's the physical. Okay, physical. Economic occupancy is how much is what they're actually paying, right? What they're actually paying. The physical occupancy, they could be 100% full, but they could be 50% physical, economic occupancy, right? So that's the difference between both of those. So you want to ask them, what is your vacancy percentage? And they'll say, I'm full. And say, okay, well then out of you're full, how many of those are actually paying? Right. So that would be the difference between those. Right. Now, when we run our numbers, we run at the physical occupancy. Right. We run our numbers at physical occupancy on the deal analyzer, but there's a place where you can put economic occupancy so you can look and see what they're actually making versus what they could be making. Right. Okay. I'll show you how that works here in just a second. And then number 3 is you want the total units. And you want the total square footage. But the total square footage, you really want the unit mix. Because they could be oh yeah, it's 20,000 square feet, and then they give you the actual unit mix and it comes up to 18,258, right? This is how it always is because they're just rounding it off, but what you want is and I've gone over this several times, but you want a table. This is how our VAs do it, right? And then you're going to put the size, and then you're going to put the price, and then you're going to put the vacancy. You see how that is, right? So you're going to say there's 10 by 10s, and I charge. And then number. Sorry. I charge, $100, and I have 10 of those, and 8 of those are filled, right? Something like that. Okay, and so you have a little chart like this. This is how my virtual assistants do it. Okay, they get all the sizes, they get the price, right, of what they charge, and then they get the vacancy and the number. Right. So then that way you can put this, you have to put this into the deal analyzer. You need this for deal analysis. All right. You need this for deal analysis. Okay. So, and then you're going to add all this up. And then at the end, you're going to have, 90 sizes or whatever is what you're going to have all the way total. Okay. Or you have 100 or whatever it is. Okay. You'll have a total amount is what it is. I'll show you how it looks in our deal analyzer, but you can just kind of get an idea of what it looks like. So it's like a chart, and you're going to be filling in the chart, right? This is time consuming because you have to put all the sizes in. Okay. All right. So you need the purchase price, you need the total number of units, the total square footage, the vacancy, and then you need the property tax. You need property tax. You can just look this up. But you need property tax based on what the purchase price is going to be, not based on what they're paying, right? Because they could have bought the property, for $10,000, the land and built it, and they're paying on $250,000, and you're going to buy it and it's going to be $1 million, right? So when you buy that property, you're going to be paying taxes on $1 million and not on $250,000, right? So you need to know what their property tax is now, but really what you need to know is how does the county or the city calculate this? County or the city? How are they going to calculate it based on the purchase price? Now, in our deal analyzer, there's a formula, right? So you just don't do anything because it automatically calculates it up. But if you don't use our deal analyzer, then you need to get this information because you need to know how much you're going to be charged when you buy the facility, right? You don't really, and that's the thing is everybody's always, what are their expenses? I mean, honestly, the truth is that their expenses are going to be, a lot different than what your expenses are because you're going to be running it different, Now, expenses to us, I mean, we run our expenses at 38% because we know that it just takes a lot of time and effort to run a facility. But I was talking to a student and he was just I run mine at 27%. I run my facilities at 27%. Well, that's the goal, right? You're going to run your numbers at 38% for expenses, but your goal is to be at 27%. And then the seller's like, well, I run it at 27%. So that's the number. But it's like, that's not how we run our facility, right? We run our numbers at 38% because, we have expenses and overhead and we just know how much it costs, right? And I'll show you that on the deal analyzer. But so like everybody's always worried about what their expenses are. But the truth is, you'll see our deal analyzer. The truth is you really just need to know what your expenses are going to be. That's what you need to know. Okay. So expenses. What are your expenses? Right? What is your property tax going to be? Okay. So for instance, even like under like insurance, right? So insurance, like people, like I'm telling you now, what I've seen lately is like, we used to be able for like 100-unit facility, our insurance was like $1,000 a year. And then it went up to $1,200 and then it was like $1,500. And now it's like $5,000 or something. I mean, insurance is like such a scam, really, but it's like, it just keeps going up and up and up. Insurance is like ridiculously priced. All right. So like you're going to see what they're charging, but the truth is that you really need to know what you're going to be charged. Right. And insurance nowadays is super expensive. Maybe in some areas like, the Great Plains or something. I'm not sure. Maybe they haven't changed that much, but on the Southeast, insurance is just doing nothing but just going up. So you want to make sure you're getting the right number for that. Okay. That falls under expenses. All right. And another thing too is utilities. Right. Now, obviously, utilities is not going to change that much, right? Utilities, like if they're getting charged $100 a month, most likely you'll get charged $100 a month. All right. So that's something that's really not going to change. But property tax, insurance, and utilities for us, those are formulas. We kind of just, have those in the deal analyzer. We've just learned over the course of the last 6-7 years that, it's just really honestly a number. It's a formula. So we just put those right into our deal analyzer. Do I know what the formula is? No, because my husband made the deal analyzer and he put the formulas in. So I have no idea what those are. All right. What are your expenses? Okay. And then finally with expenses too. So this is like, these fall under expenses. And so you have property tax, utilities, insurance. And then on top of that, you have, there's 4 others, like kind of like subject, like 4 other areas. Okay. One of them is going to be, we call it like maintenance. And then the other one, we call it staffing. And then we have one that's called software. And then we have marketing. So we really honestly have 6 different areas of expenses, not including the mortgage, right? Not including the mortgage, which is an expense, but it's not included, right? This is to calculate your NOI. But maintenance, for us, maintenance includes our boots on the ground person, right? Because that's maintenance. He's the maintenance person. All right. So maintenance is the boots on the ground person, and then any type of repairs or anything that you have to do. Okay. Staffing is like our office people, right? So like, people that answer the phones or handle auctions, this kind of stuff. Do this, put the tenants in, this kind of thing. Now, if this is going to be you, then obviously, you don't have to put any number in. All right. Or you can put a number and say, look, I'm worth this much money or whatever, So, but like for us, we have people that do all this. Software is included. Software is your property management software, which obviously costs money. And then also your merchant account, your merchant fees. You have to make sure to include that. So this is merchant and software. Because your software, like when you put everybody in, your software really is what does your merchant fee. So we combine that into one and put that all together. And then your marketing is obviously your marketing. That includes your website, Sparefoot, Google Ads, what signs in the yard, whatever you're going to do in order to get tenants into your facility. It's marketing. Okay. So now you have a list of the expenses. And remember, those are your expenses, not the owner's expenses. I would say most of the time, a lot of the times, owners aren't even really doing a lot of marketing. So you're not even going to see that, but you know that in order to get tenants in, you've got to do marketing, right? Okay. So this is expenses right here. And let me see, what else do we need? So this is everything that you need. So you've got purchase price, vacancy, total units, total square foot, unit mix, expenses. Okay, and then another thing that you need if you're going to be is what we call after updates, but it's really like opportunity, which we call after updates on our deal analyzer. But this is like, okay, can I increase the unit mix? Can I increase the square footage? Can I increase the rates? And so this is like kind of what you would do, and then you would add your building costs, or CapEx. So when we evaluate a deal, we're looking at three things. We're looking at as is, right? What is it making right now, right? As is right now. And then that's number one. The number two is what we call potential. And this is really for mismanaged facilities. Okay. So potential is like it's 40% full, and I'm going to take it to 92% full. All right. So this is your vacancy decrease. Is what that is. All right. And then, so that's potential for us. Okay. And then number three is opportunity, which we call value add, or we call it after updates. Right. This is just my husband's brain, the way he's thinking as the manager of our facilities. All right. So the opportunity of the facilities that we buy, because we buy severely mismanaged facilities, is that we are going to be fixing those up and stabilizing. So what can we do to value add that property? We can increase the rates. We can paint it. We can, we can clean it up or whatever. We can get the old tenants out and the new tenants in, right? So that's really value add. And what is the value of that property going to be after we update all of the value add that we can do? So those are the three different ways. We separate out our deal analyzer into those three ways. And that's how you really should be looking at it. As is right now. Now, if it's an income producing property, let's say it's an income producing property and it's at 90% full, right? Then there's no potential to increase vacancy, right? The only potential is maybe to increase the rates. So you really want to look at, can I increase the rates? Can I increase square footage, or can I increase the unit mix? All right. That's really what it is. Okay. So that's how when we go over the deal analyzer, that is how we're going to be looking at it. And then in the deal analyzer, all right, and this is kind of the steps, the deal analysis steps. Okay. Step one is you need to put your inputs in. Your inputs are going to be these, right? This is your inputs right here. Okay. You're going to have to put your inputs in so that you can look at you can evaluate your deal. And these are the inputs. Now you know what you need to get from the owners or whatever. Now, if you go to a broker, if you go to a realtor and you get the information from the realtor, you're going to have to extract this information from what they give you, right? So they're going to give you hopefully they'll give you a P&L and a balance sheet, tax returns, a unit mix, or rent roll, whatever they're going to give you. And then you're going to have to extract that number from that information. And then you're going to put it into your deal analyzer, whichever deal analyzer you use, whether it's mine or somebody else's. All right. And so that time that it takes to extract that information is a lot, right? So just know that you got to give yourself some time to find this information so that you can put the inputs in. All right. That's why I like to talk to the owners first. I mean, essentially, our process is like talk to the owner and get the information from them. We really only ask them for this much information. And then what we do is like we just ask them, just like, in the scripts that we talked about, right? The script on how do you get the purchase price is like you say, look, I need to know if you've had an offer before. Have you rejected any offers? What number are you thinking? Tell me this number, right? So that's one of your scripts. The second script that you're going to ask them is, okay, so you've given me all this information here. Can you prove this to me? That's the question. Are you going to be able to give me a P&L and a balance sheet and tax return so I can take that information and go to the bank? Like I just had a Zoom call with an owner last Friday, and I was like the two owners, they're partners. It was a deal in Wisconsin. It was like for one of my students. And they said, then they'd given us all the information. They looked really good. And I said, okay, can you prove this numbers? He said, yeah, we can give you a P&L. We can give you a balance sheet. We can get anything you want. And so they're working on getting all that information because obviously it takes time to do that. But, another thing too is like when you're going directly to the owner and you're asking for this stuff, like you don't want to ask them for a P&L and a balance sheet. Like that, like they're like in their mind, they're not even thinking they want to sell. And all of a sudden you want to give them an offer and you're asking for all this personal information. And a lot of owners too, like when we talk to the owners, we say, they'll say like, I don't want to give you that information unless you come down here and meet me. If you come here and meet me, I'll show you everything that you want. Right. And so that's kind of like that happens actually quite often. So you just have to know that those types of owners, those are the types of owners they want to know, like, and trust you. You got to get down there and you got to charm those people, right? So there's all different kinds. There's different types of owners, and every owner is completely different. And you got to really kind of, when you're talking to them, you got to get a feel for like, what type of an owner they are, so how to talk to them. Okay. So the first step is deal analysis. You're going to get all this information so we can input it into the deal analyzer. Right? And your inputs, the second step is in the inputs is filling out the unit mix. You got to get all that unit mix in. And we have one, actually the one that I'm going to show you, they have like a ridiculous amount of sizes. I mean, it's like 20 different sizes. All right. So you got to sit there and input all this in. When you input all the unit mix in with with the price and the vacancies and the numbers and the sizes and all this kind of stuff. So this just takes a little bit of time. So you're going to input all the information in. You're going to put the unit mix in. You're going to, the next step is competition, right? You're going to look at the competition. You got to do a competitive analysis. All right. What are all the competitors charging? And you need to compare apples to apples. If they have only 20 by 10s and you have 10 by 10s and 10 by 15s, this is not a competition, right? Competition is like, what are all the competitors that have 10 by 10s and 10 by 15s doing, right? So, when we do our competitive analysis, it's apples to apples. That's what it is. You want to keep that in mind as well too. So and then you need like a minimum of 3 or 4 competitors, right? But also at the same time, you want to respect which market that you're in, right? Right. Remember that you have primary, secondary, and then tertiary, right? A primary market is like less than 1 mile. Is that greater or less than? That's greater. And then this one is 1 mile, and then this one's like 3 miles. And then this one is the long way. This one is 10 miles. Okay, so 1, 3, 10 miles, right? So your competitors need to be in like these ranges, right? You don't want to have like a competitor that's like 10 miles away if you're in like a primary market. I mean, that's not a competitor, right? So, and this right here, this section of the deal analysis is like the most important, because this is what's going to determine what your opportunity is going to be, right? This is what's going to determine, is there an opportunity inside this deal? Okay. So that's why that's super important. That's competitive analysis. And then Once you get the competitive analysis, then you need to start looking at the valuations. So, and the valuation includes other income. If there's other income, you need to add that in. All right. Now, when you're doing deal analysis, if they like, we have one right now that we're looking at, and I can't remember what state is in. Can't remember, but it's like, it's on like this like huge property. I think it's like 17 acres or something. Like it's like a huge, massive piece of property. And then he has his house. And then he has an apartment, like two different apartments, and a commercial space. And he's got RV parking. So that's what he does on his land, kind of down at the end. He does all this RV parking. And there's still all this land as well, too. So probably a couple of acres of like residential and then commercial. And he's got the RV and boat parking. And then he's got like a whole bunch of land that's not doing anything. And it's almost like major highway. And, when you're evaluating a deal like that, you can't just put every, he says like, oh yeah, I'm making $100,000 a year. You can't just say, okay, he's making $100,000 a year, right? Because you have to split up every single one of those incomes and you have to look at each one of those incomes. So when you're analyzing storage, only storage is being analyzed, on the input section, right? And then you can put other income in the other income areas, right? And so we analyze storage by itself. And then if they are making $500 a month on a couple apartment buildings, we'll put that in there as other income. Or if they're making money on this or whatever, so you put it in as other income. So you don't want to combine all that. Because what that does is if you combine everything, it screws up your price per square foot. And you want to make sure that your price per square foot is clear so that you can compare the competitors to that price per square foot. Does that make sense? And so then also another thing is what I like to do too, is like just like that deal I just told you about, if there's a lot of different other incomes, then you can really do a separate deal analysis. So if he's doing boat and RV storage and he has like regular storage, then one deal analyzer is analyzing the boat and RV storage, because boat and RV storage is typically around like 20 cents a square foot. In most places, it's around 20 cents a square foot. And then the average price for storage nationwide is like 80 cents a square foot to 90 cents a square foot. So like if you took that 20 cents and put it into the 80 cents, then obviously it's going to screw your numbers up, right? So we analyze the RV and the boat storage separately than we do the storage, okay? And so we do that by analyzing other incomes separately. Let's see what else. So then we have the financing inputs. This is our tab. These are all of our tabs. That's why I'm going through them. But financing inputs is okay, like how I need to run the numbers to see how much this thing is worth and to do the, to come up with an offer, right? So that's what financing inputs is. And so we'll go over that. And that's like in our deal analyzer, we run 5 different numbers, 5 different offers at the same time is what we do. 5 different offers at the same time. So that's under the financing inputs. And here is where you want to know, where's your cash on cash return? And then things like, what's your down payment? This is like lending inputs is where this goes, right? So obviously if you're paying cash, right, you don't have lending inputs, but you still have a cash on cash return, right? And then if you're doing bank financing, well, then you need to know, what is your down payment? What is your interest rate? What's the term of your loan? All these different inputs have to go in so you can run that offer. So we do that in the financing inputs. So for deal analysis, you need to know, you need to have kind of an idea of what the terms are going to be if you go to a bank. I'll show you kind of how we do that here in just a second. I got a couple more minutes. It's good. And then let's see. And then overall, we're going to do cash flow. What in the end is going to be our cash flow? How much money are we actually going to make? So you're doing step by step on all these different things in order to figure out this, right? Once you figure out your cash flow, then you're going to make your offer, right? Then you're going to make your offer. Okay. So you have all these different steps, inputs from your call, unit mix, competition, that other income, financing, and then you get your cash flow from all that, and then you make your offer. All right, looks good. And then, so what I'm going to do is I'm going to pull up the deal analyzer on the facility that we are looking at right now. And then we can just go over that for the last 10 minutes or so. We'll go over that and I'll show you. All right, so this is what our deal analyzer looks like. Everything in yellow is your inputs. Everything in yellow is your inputs, okay? So this is the storage facility. It's Beacon Storage. We're buying this. We're closing in about a month. We've been through all the due diligence. We got it under contract and did a lot of due diligence. Oh my gosh, a lot. This is a severely mismanaged facility. I mean, it's just like, it's severely mismanaged. This is a climate control building that's 25,000 square feet. 25,000 square feet. 10,000 square feet of that is, I say 10 to maybe 12,000. We're not 100% sure yet because they really honestly, just the whole thing is weird. But it's probably about 12,000. Yeah, it's about 12,000 square feet of storage. There's probably about 2,000 square feet of it that's not being utilized in the storage area. Okay, there's a couple little sections that keeps like, as soon as we buy this thing, we're going to build that storage out as well too. You know, because he can just like, they have a whole bunch, like this facility has a whole bunch of extra like metal walls and stuff like this. They're going to they're throwing it in with the buy. And then Pete's going to just take all that. He's just going to build it all is what he's going to do. I mean, he's not going to do it, but his team will do it, right? So probably in the end, it'll probably be like 12 to 13,000 worth of square feet. But right now it's about 10,000. So you can see here, 10,234 square feet. That's like us actually measuring, getting out and measuring and trying to figure it all out and stuff like this, you know, because the unit mix is also really crazy. It's 143 units. This building also has commercial space. So remember, 2 different incomes. The storage is being evaluated here, right? And then the commercial space is under other income. Okay. And and then you can see here that the vacancy is 50% full. 50% full. Okay, so you can see the purchase price is $2.4 million. And on our deal analyzer, what you can do is toggle between each of the, I think you can do it here, right? Yeah, you can toggle between each of the offers is what you can do. So there's a cash offer, 3 owner financing offers, and then a bank or private lender. If you're going to use a private lender as well too, so we have that. All right, so we're actually, this facility, we're getting it owner finance. Now this is a mismanaged facility. There is no bank that is going to be funding this thing. That's for sure. All right, and so that's really like when you know that a bank will not finance anything. Well, at least what I do. What I do is I push owner finance. All right, I really push owner financing, and I say like, look, you know, this is a severely mismanaged facility. There's no bank is going to finance this, especially nowadays because the market is just so crazy. So I really think that you should consider owner financing this. Would you be open to doing that? And then that way we can make this facility stable. And then in a couple of years, we can refi it out. Would you be open to that? So we did. We had talked to the owners about this. And he said, yeah. So, okay. So you can see the annual income is $108,000, right? I mean, you know, when you're like, yeah, $108,000, that seems like a lot of money, but not when you're supposed to be making, you know, double, right? You know, it doesn't seem like a lot of money. And so a lot of banks, they'll look at this and they'll say like, you know, this is really like, you know, this is really like a risky investment. So we are not going to finance this. Okay. Okay. All right. So you can see here that, another thing we didn't talk about is this right here. Oops. I don't want to screw that up. But the market cap rate is, we have it at 7. Now remember, when I went over primary, second, and tertiary markets, right? Each of those markets has a cap rate. That's called the market cap rate, which is the cap rate that you can be buying at right now. Now, this facility is kind of near Orlando. It's in Leesburg, like north of Leesburg, which I would consider honestly a primary market. I mean, I honestly would consider this a primary market, and most likely we'll be able to sell this at like a 6 cap. Let me see if I can figure out the numbers here. Okay, got it. Okay, so yeah, let's look at that. So this is actually the numbers that we ran at. So this is in Leesburg, which is like right next to the Villages. If y'all know the Village, if y'all heard of the Villages in Florida, Villages are like booming right now. And Leesburg is kind of this town that's like it's getting built up. They're really trying to clean it up and stuff. And this is where this facility is. So it's very good. Florida is a great area to be in, anyways. It's a very good area. Okay. Okay, so now you see the inputs here. Remember, current, potential, after updates. Current, potential, after updates. Those are the 3 ways that we're evaluating the deal, right? So you can say I'm taking it from 50% to 8%. So I'm taking it from $108,000 to $198,000, right? From 176 to 182. Now, the price that they're charging, like the prices that they are kind of sort of right at where the other competitors are, right? So you can see it's $1.76 and our competitors are $1.82. So there's really not a lot of room to add for, rents to go. Now there's, it's like, 5 cents, or what is that? Yeah, that's like 5 cents. So it's not too bad, right? And if people say, 5 cents, that's not that much, but really, honestly, it's kind of a lot. And so, so you can see we're taking it currently from 50% to 8. And then after updates, we didn't add our unit, like how many units we're going to be adding, anything like that. Even though there's still a couple thousand square feet worth of space, we did not put that in. Really, what we did was just analyze the deal like as is right now. If we bought this thing right now, where would we be? So that's what I'm looking at. Okay. On this, all right, not adding any space. Now you can see here that we've got like a clean out, there's building. If you're going to add, if you're going to expand and stuff, you put your CapEx. The closing cost in dollars, it's going to cost $125,000 because a wholesaler brought this deal to me. That's how I found it. A wholesaler brought the deal. So to me, all right. So it's going to cost $120. That's why I said, if you want a wholesale self-storage, I mean, this guy, he's making $125,000 off of just finding this deal and giving it to me. All right. So if you want a wholesale self-storage, I am okay with paying $125,000 if I know I can take it from $2.5 million to $5 million. All right. I'm okay with paying $125,000. Okay. Property taxes, $15,600. This is a formula. Oh yeah, you could see the formula here. So you could see the formula is equal max, and then it has like times 1,200, and then it has like another times 0.0065 times 0.6, right? So I think the millage rate is about 0.65. 0.0065. So that's how he kind of calculated that. So people that, if you want to know how we're calculating that, you can do that. And then the utilities is just a number, and the insurance is actually another formula. And it's the 12 times C13 times 1,200. All right. So you see, like, that's how we came up with our numbers. And actually, my husband Pete, he came up with those numbers. So I'm not sure, like, that's just the numbers that he said, use this. This is where we're at. And then property maintenance is here. Remember, property maintenance, I told you, was the boots on the ground person. The person that's going to be maintaining and fixing up and cleaning this facility, overlocking, cleaning the units out, stuff like that. It's going to cost us about $36,000 a year for that. $7,400 a year for staffing. That's the phone person handling the auctions and doing the phone. The software is going to cost about $9,500. Remember, the software plus the merchant fees. The marketing is going to be about $1,887 a year. It's because we use Google ads. We know how to market and stuff like this, right? So, and then our mortgage is right here. It's minus our mortgage, right? So we'll look at that here in just a second. But so you can see here's the inputs. This is where you're inputting your information. That's step 1. Step 2 is the unit mix, right? So remember I told you there's like ridiculous amount of units, like sizes here. So we have all the sizes. the square foot of the size, the number of units, and then the total square footage, right? And then you can see again, current, right? These are the rates that they have on their website. If they were actually full at these rates, they would be at $2.09 a square foot. They're obviously not, but they're charging higher rates. They're just 50% full. They might be 50% full because they're charging too much based on the competition, because the competition is here. This is their apples to apples, and then they're at $1.82 a square foot. You see? And so that's how we're comparing apples to apples for the competition. And then we have over here the number currently filled. Remember, this is economic occupancy right here. Economic occupancy are these numbers, right? This is what they actually have filled. Okay, so right here, you can see there's 103 units at 10,234. They should be making anywhere from $18,000 to $21,000, depending on where we're at with the price per square foot. We went ahead and just went with the competition at $1.82, which comes out to $18,636 a month. Okay, and see the competition here, you can see that we have the 4 competitors within a 2-3 mile radius, just right there in Leesburg. We just looked at, and we compared them all apples to apples. Now, obviously, all the sizes that the competitors have, competitors don't have it. Competitor doesn't have a 3.9. So we just kind of keep those prices where they're at right now is what we do. But if we do have 5x5s, 5x8s, 5x10s, you see all the way through, then I'm screwing it up. But we're looking at apples to apples on that, okay? Okay, all right. So that's competition. I don't know where it's at. I'm screwing the screen up. But, okay, that's competition. Oh, here it is. Stuck over there. Okay. Let's move on. Okay, so we did competition, and we did unit mix, competition, info, and then remember we're going to do valuations. Now we evaluate 3 different ways, right? Current, potential, and after updates. Current is here, right? So we have other income, $126,000, which is what they're making from their commercial retail space. Right. So they have a commercial retail space that they've got some really nice offices they're renting out. And so we just kind of left that number here, and in the potential, is here, and then also in the valuation updates. Okay. Another thing is that they have on this building right next to it is this massive, huge fenced in parking space that they're doing nothing with. They don't have any parking there at all. It's just this empty space. And so we calculated out that space right there you can make around $60,000 a year in parking, right? Because we'll set up lanes and all this kind of stuff. And then also, so any other incomes, we separate that out. Okay. Now you can see our valuation here comes out to 143 units, $130 per unit, right? The valuation is coming out to $4.3 million at 1.8 as an equity. It's almost $2 million in equity. The NOI is 307. Okay. And then after we pay our mortgage, we're at $223,000. All right. Now the financing inputs are here. Remember, I told you we run our numbers up for 5 different offers, right? Cash, owner financing, bank, private financing. We can do fixed terms. We can do interest-only terms. So look at owner financing number 1. This is what we got. Okay? It's $2.4 million. There's a 30% down payment, which comes out to $720,000 that we have to come up with to buy. It's 5% interest. It's interest-only loan for 2 years. Interest-only loan for 2 years. So we have that here, which comes out to $7,000 a month. So we will be paying $7,000 a month for 2 years, interest only. Okay. So you can see our loan amount is $1.68 million. Interest we'll pay $168,000 in interest. Total paid $2.56 million, right? In 2 years, we'll pay it off. So we'll have to refi it out or sell it. So we've got 2 years to stabilize this deal. 2 years, okay? And so then you can see that our cash on cash is at 26%. 26%, that's amazing cash on cash deal, right? And then our net after mortgage is $223,000. $223,000 net after mortgage. Isn't that amazing? Isn't that a great deal? So, and now obviously we have to get it filled up. It's 50% full. So it's going to take 2 years for us to make this amount of money, right? But we'll get it there for sure. All right, we'll get it there. Okay, so but then you can see you can run your numbers cash, all different ways to owner finance, bank, and private financing as well too. And then once you do that, you can send out your offer letter, right? So your offer letter looks something like this, right? So you say, thank you for, thank you for the interest in getting an offer. Here's our little tab, right? Here's our little matrix of what we're showing the owner. Here's our offers, right? Purchase price, monthly payment, interest rate, term of loan, down payment, total interest to the owner. So here's this, okay? Oops, I keep hitting this. And then it's like, okay, thank you for, let us know what you think. You can see here, either like, look, we've come up with a lot of owner financing offers. We really think that this deal is perfect for owner financing. It's best for you if we owner finance it, because it can save you a lot of money as well too, And so we put that in there as well too. Okay, so we put that here. And then we just send this out. We send this letter as our offer letter to the owners. Okay. So that's the steps. And then finally, we have the cash flow. Right. So here's our matrix again, just the same thing that's going on to the offer letter. And then we do current versus after updates. And remember, we're owner financing number one. So our gross monthly income is $19,500. Operating expense is $7,000. Our NOI is $12,486 minus our mortgage, minus our net, and then equals our monthly net income of $5,486. Our cash on cash, as is right now, if we did nothing, is 7.8%, which is actually isn't too bad, but so 7.8. But once we get it stabilized, we get it from 50% full to 90% full, we'll be at $32,000 a month gross income. That's including doing something with the parking, adding some, getting that filled up with all the extra space that we have and something like that. So we're shooting for $30,000 a month is what we're shooting for, right? Operating expenses are still the same because you want to increase your income, but keep your expenses the same, right? Like when you increase your income, keep your expenses the same. So my NOI comes out to $25,000. My mortgage is $7,000. So my net income is $18,000, which makes my cash on cash return 26%. Okay. So yeah, this facility is going to be a lot of work for sure. Right. But in the end, we'll be able to sell this thing for $5 million and make, $2.5 million. Okay. So that is deal analysis for one of our deals. You can apply this to any type of deal, and you can get the deal analyzer. If you're interested, you can get the deal analyzer. If you go to my website, right, and you go to stacyrossetti.com and then just click on deal analyzer, you can buy the deal analyzer. There's training videos that go with it as well too. And for some reason, it's not popping up, so I don't know why. In the end, you can run the numbers on any type of a deal, and you can use the deal analyzer for that. But if you don't want to use a deal analyzer, just get your own deal analyzer, right? If you want to do that. But if you want access to my deal analyzer, just go to stacyrossetti.com, click on deal analyzer. It is now available to the public. So if you want access to that, you can, and then you get some training videos that come with it to show you what to do, okay? And so that's available to you as well too. The deal analyzer is $497. That's how much it costs, $497. Okay, so for $500, you can have access. You can run your numbers, just like I did. If you want my Crexi deal, then just email questions@stacyrossetti.com. Crexi is a software that we use to find property, to find storage facilities. So if you want that discount, and if you want me to introduce you to Grant, he'll do a demo for you, and then you can get my discount as well too. If you don't go through my discount, it's like it's like way more expensive. Okay. So make sure if you do want to get Crexy, message us. Okay. So that's a bonus for you being here live on the webinars. Again, okay, so I'm going to hop off right now. It's already 6 minutes after, and I need to go to my pitch. I'm going to be pitching my fund, stacyrossetti.com/fund, right? It's a 506c fund for accredited investors. So if you've got money and you want to put your money somewhere, then definitely hop on the fund. Now, this deal is going in the fund. So that deal that I just showed you, the Beacon deal, that will be in the fund. So I'll be able to share the $2.5 million that we make on that deal with all my investors, right? Those are the kind of deals we put in the fund. All right. I appreciate you guys listening. And go to stacyrossetti.com/fund, F-U-N-D, for my fund. Okay, we're going to do that right now. All right. I hope you guys enjoyed this, and I will see you next week. Take care.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.